Chapter 12, we're going to discuss essentially the risk topic. It's how does the stock market, or how do markets in general help us to determine the value or the price that we accept for taking on the risks of investment. So the first graph here basically shows us the history since 1925 of some very basic kinds of asset classes. As you can see, we have them listed here. The red is the small stocks. The green down here are Treasury bills. Yellow's corporate bonds. The world portfolio is next, followed by the S&P 500. And I guess in general terms, we just want to say, well, just by observation, which asset seems to create the highest level of return. And of course, since they all start at $100, you can see that small stocks over this time frame, 1925 to 2005, and a little bit longer than that, I guess, basically has far exceeded some of the other assets. The additional, again, just by observation, of course, but the different observation is, well, which of the things happen to be the riskiest? So to discuss risk, you just have to, from observation point, we want to look at variation. And if you look at the corporate line, the yellow line here, there's just not that much variation from time frame to time frame. But small stocks, then followed by S&P 500, these all have varying levels of volatility that are far more. In fact, you see the green line here is the Treasury bill line. I mean, it is almost smooth. There's very little change in it at all. So from this basic observation, we find that small stocks had the highest returns, T-bills had the lowest. Small stocks were the riskiest, T-bills were the least risky. So it appears, looking at the data, that to get higher risk requires a higher rate of return for us to invest in it. We can talk a little bit about probability distributions, right? What is the chance that certain events occur? And of course, this is a basic statistics. It's descriptive parametric statistics, right? Each possible return has a chance of happening. So in this example, we have a stock to trade for $100. There's a 25% chance it'll be 140, 50% 110, 25% chance it'll be 80. So we can then plug that into our forecasting. Here's what we think the prices will be in 1 year. If you know what the predicted prices are, you can then calculate the predicted returns. So to calculate this statistically then, we need to have our basic formulas for calculating these descriptive statistics. Again, this should be all review. The average or expected mean, it's the average return. It's the product of the weighted returns of potential outcomes. Variance is a measurement of the chance that the actual outcomes are different than what we expected, the average. Standard deviation is the square root of that. Now, variance and standard deviations are both measures of the risk, of the probability that of a probability distribution that these particular outcomes will occur. So for this company, this BFI company, we can calculate the statistics. So in finance, standard deviation is what we use as the measurement or the metric for risk. It's a little bit easier to understand and discuss than variance. So that's essentially why we use it. In the worksheets for this particular course, there is a spreadsheet called standalone risk. And that the standalone risk spreadsheet, we can input the data and we can find the basic ideas here, or the basic flow of statistics. The average rate of return is 10%. Variance, as we calculated before, is 4.5%. Standard deviation is 21.23%. We have what's referred to as the coefficient of variation, is the difference between the high and low. So you take 40 minus the low here of -20, that's 60. And we also have what we're going to talk about a little bit later, are the confidence intervals. There's a 95% chance that the actual return 1 year out will be between these two numbers. So how is that ultimately determined, or how is that influenced, or how is it indicative of risk? Well, the key component to this calculation is standard deviation as part of the formula. So the smaller the standard deviation, the smaller the range it is here between these high and low ends for this 95% confidence level. We can also do this for historical returns, right? We can look backwards. The rate of return on an asset is, in this case, we're talking about a stock. It's the dividend next year plus the price next year divided by the current price minus 1. And if you do a little algebra there, we would find out that the rate of return on a stock is essentially the dividend yield, that's the dividend divided by the price, plus the capital gains rate, the difference in capital gains for the company. So let's take a look at the S&P 500 and some other stocks, just to see return-wise how things seem to pan out, if you will. So here's the S&P 500 index. Here are some dividends that are paid. So here is the actual rate of return for the S&P 500. And just so we kind of note a little bit, people are always worried about the stock market, but if you look at the S&P 500, there's 10 returns from 2001 through 2011. Of those 10, there are only 2 that are negative. Now, they're pretty big numbers, but we also have very large positive numbers to offset them. So of these last 10 years, the 10 years of the 11 years that are shown here, the last 10 data entries, I mean, the stock market only was negative 20% of the time. So if you can make money 80% of the time, that probably is a pretty good indicator that investing in the stock market's a good idea. Now, when you look at stocks, individual stocks, that can change. In this case, 50% of the time, Microsoft lost money. So it means now it's a 50-50 shot. That's why in the end, as we get to the next chapter, you want to create portfolios so that when some things are doing well, other things are doing poorly, so that they can offset each other, so that we can smooth out these returns and hopefully get rid of some of this negative outcome. So if you count the number of times we have return, obviously we can estimate the underlying probability distributions. So when you go back to that previous chapter, I mean, we obviously saw how many times it could be very bad, how many times we could have higher returns, and we can create a probability distribution to assess for these particular types of investments. So here are, again, some annual returns for, again, we have large stocks, small stocks, corporate bonds, and treasury bills. And really the only really important picture that you get from, or a piece of information we get from this picture, is the differences in risk. And of course you can see that T-bills are very closely distributed. There's not much range, if you will. And if you go down here to small stocks, you can see that they're spread out all over the place. So obviously investing in government securities is much less riskier than investing in small stocks. So what does the data actually show us? Well, let's think about risk and return. Small stocks averaged, again, between 1926 and 2011, small stocks averaged about 18.7%, and they had a standard deviation of 39.2. S&P 500 was 11.7%. It's a lower rate of return. Small stocks make more money on average than big stocks, but big stocks are also less risky. Corporate bonds, likewise, less return for T-bills. So as you go down the list, you find that lower returns are associated with actual earnings of less risk. We can also then use this historical data of assets to predict the future. The problem, though, is since it is a prediction, there is some error. So we need to incorporate what's referred to as a standard error measure, right? Let me give myself some leeway so I don't have to predict an exact number. Essentially, I want to come up with a range. And this is what we talked about a little bit earlier with the 95% confidence interval. In this case, you see that for the S&P 500, 12.3% was the average rate of return they had here, plus 2. The reason we're using 2 here is 2 standard deviations away from the mean. That gives us the 95% confidence interval. And then here we have the standard error divided by the number of observations. So in this case, we end up that there's a 95% chance that the S&P 500 will be between 7.7% and 19.9%. If you do a little subtraction there, you see it's roughly 12.2%. In addition to that, you'll notice that there's no negative numbers. So there's a 95% chance that the return you're going to get is going to be greater than 0. You're not going to lose money if you invest in the S&P 500. If we go back to our previous example, we can see here that the 95% confidence interval is very large. 82% is the range of this interval, and we can also see that there's a hefty amount of it is actually negative. So by investing in this particular stock, there is a fairly significant possibility that you ultimately could lose money. So that's the end of part 1.